It is May 12th, 2026, and, looking across the companies we track today, we are seeing some wild contrasts. You have an energy startup physically tapping into Cold War defense plutonium just to supply AI data centers. And then you have major retail brands anchoring their turnaround narratives entirely on pending tax refunds.
The quality of these reports was all over the place today. In the energy hardware space, the physical progress was incredibly real, even if the near-term financials looked heavy. But over in consumer retail, we saw companies posting paper illusions to hide actual operational decay.
Right. So to map the day out, the real theme here is extreme physical workarounds for the AI grid on one side and pure accounting camouflage on the other. I want to start with the physical bottlenecks, like Oklo. I mean, they are building massive new nuclear micro-reactors for Meta.
Well, they are trying to, at least. The problem they hit is that standard commercial uranium supply chains are totally fractured right now. So they bypassed the market completely and secured surplus U.S. defense plutonium instead.
That is actually wild, just going straight to the nuclear weapon stockpile because standard pipelines are broken.
I mean, it works. They actually set up a $2.5 billion stock facility solely to handle the prepayments they expect for those campuses. The cash burn of their development phase looks intense on paper, but securing that defense fuel is a massive strategic validation.
That physically constrained reality is bleeding into other tech reports today, too. Nextpower has historically just been a solar tracker company, but they made a hard pivot. They bought up battery and inverter companies to pitch hyperscalers directly on startup speed.
Yeah, because the milliseconds matter. A legacy natural gas peaker plant takes critical seconds to spin up when a data center needs backup power. Batteries hit the grid in milliseconds. Nextpower is weaponizing that exact physical reaction time to kill natural gas contracts.
Except Nextpower also gave us one of those accounting mirages I mentioned. They reported this fantastic-looking jump in net income, but underneath, their core operating profit actually fell 13%.
Exactly. That was just a giant tax provision cut, flattering the headline. They used an accounting line item to mask the core margin pressure. And that strategy was surprisingly common today outside of tech. Look at what Under Armour pulled.
Ooh, the margin turnaround story. I was looking at that. So they told Wall Street to expect significant gross margin improvement this year. But more than half of that promised recovery is completely reliant on an uncollected $70 million federal tariff refund.
Right. It has absolutely nothing to do with selling apparel. It's just a pending government check doing the heavy lifting to cover up an incredibly expensive break with the Curry brand. If that refund gets delayed, the whole recovery narrative breaks.
It really just underscores the difference between real structural progress and clever paper games. If you are curious about the exact timeline on Oklo getting commercial regulation or how Under Armour navigates this pivot, those deeper call details are sitting in the individual company episodes right in the daily feed.
The Nextpower financial breakdown in those episodes is worth hearing, too. The optical distortion is pretty incredible. Catch you tomorrow, Susie.
See you tomorrow.